welcome back to Cash Flow Podcast, where we are keeping it simple, staying on that theme, and we're going to bring up your toughest topic, whether you like it or not, and it's taxes. Because even though it's that one we never talk about, it is the one that I get the most calls about when a big surprise tax bill shows up. So how do we anticipate taxes is the question that I get. And there are all sorts of taxes, but I'm going to focus on income taxes today. And know that two things. If you make money, you will have to pay taxes. And if you have to pay taxes, you'll never get out of them, no matter what you do. File bankruptcy for your company, file bankruptcy personally, do whatever you want. You're not going to get out of that bill. So this question is one of my favorites because we really do need to know how to anticipate that number. So usually as entrepreneurs, we start out the first 2 years, if you're like me, you don't make any money. And if you don't make any money, there's no tax bill. So you don't have to worry about it. But then you get that third year, that fourth year, and you start to make money. Things are going great. You feel good, and you should feel good because profit is good and you're getting profit. You're spending less than you're earning. And there's nothing better than that feeling. If you're not paying attention to the fact that, okay, now I've hit this moment where taxes are going to be my biggest expense, then the April after that year, you are going to get a tax surprise. And there are a couple ways, but there's one great way to avoid it. You know, every time money comes in, that you're going to have to pay taxes on it once you're profitable. So go ahead right away and set that money aside every month, starting in January. If you know during this year you're going to make money, start putting money away in January. How much should you put away? I'm going to recommend this, but it is not tax advice and it's not accounting advice. And the reason I said that is because every single business is different. But if you're a business with very little expense, like you're a freelancer and you do all the work and you really don't have a lot of expenses except some software maybe, you want to put almost 30% away. And I guess that sounded like tax advice, but it's not tax advice. You want to put 30% away and just put it where you don't even see it. Kind of like if you were in the workforce, you'd have a 401k and they'd take it out of your paycheck before you even see it. Put those taxes away before you see them. This is what we do in a couple of the companies that I'm a part owner in, is we put away enough taxes so that every owner will be able to cover those tax bills. Because here's the thing, even if you leave that money in the business, like say you make $100,000 in net income this year, even if you leave that money in the business, you still got to pay taxes on it. That kind of sucks. Because you may decide to spend that money during the year, or at the end of the year, or at the beginning of the following year. And if you don't spend it in the same year that you made the money, then you're going to owe taxes on it, and that bill's going to come on April 15th. So if you're knowing right at the beginning that you're going to have a profitable year, just start putting that 30% away if you're a freelancer. Now, if you're a bigger business and you got a lot of expenses, then you can put away something less than 30%. The numbers that I advise my clients, depending on their situations, and everyone's unique, is somewhere between 15 and 25% if they've got expenses in their business. I'm not going to go into how to calculate that. We cover that in the KISS Club, because it's pretty important for everybody to know individually what that number might look like. And it's easier to calculate than you think. But as just a rule of thumb, 30% if you're a freelancer, somewhere between 15 and 20 if you got some serious expenses. All right, but now you might be in a situation where I really can't put that money away because right now I've got a ton of debt, and every money that I make in profit, I'm actually having to pay a credit card balance, an old credit card balance, or pay off a loan that I had to take. So I don't have that cash in the bank to put away, and that's real. So the second thing I want to tell you, and this isn't so much how to anticipate taxes, but how to deal with that. If that's the case for you, we actually have an episode a couple back, and I'll ask Francis to drop that episode number in the notes, because you can get a loan from the IRS when you know that tax bill's due. And I got a lot of detail in that other episode about how to do that, and it's really worth it. They're good terms. Well, they're not great interest terms, but it's good terms for you because your biggest problem now is cash. And if your biggest problem is cash, then being able to spread that payment out over a 2, 3, 4, 5-year period, depending on your situation, will be extremely helpful. Okay? So first, if you look at your year and you go, I think I'm going to make some money this year. Start putting money away. If you can't, for whatever good reason, and there are good reasons, know that come IRS time, you can take a loan out with them to get this done. Okay, and that's regardless kind of your personal financial situation and credit score and all that. And I'll tell you why. Because they just automatically go take that money out of your checking account, period. It's not optional. So they really don't care whether you have a good credit score or not, because they're going to go get their money first. And if it doesn't come out of that checking account, they'll take it out of other things. And you want to always be able to make that payment. So when you're on the website doing this loan, make sure you put a payment that's really reasonable that you're going to be able to make. Okay. So that first thing, that's how you anticipate the first year. And literally just use the back of an envelope to scribble it on. You don't have to do any fancy spreadsheet. You can be like, I know I've got 5 customers. They're all going to pay me $10,000, in total $10,000 a month. So at the end of the year, I'm going to have $120,000 in revenue. And I know my expenses, because I have a software bill every month and I pay a contractor every month, my expenses are going to be $20,000. So given that, I know I'm going to have $100,000 in profit. Okay. That's what I'm going to have to pay taxes on. So you don't have to do a fancy forecast. You can literally just jot this down on the back of an envelope. But here's the big thing. Once that first year's happened, whether you were ready for it or not, know that the second year, you got a bigger problem. It's a good problem to have. You're making money. Don't get me wrong. But your bigger problem is that you're going to have taxes due again next year if you stay profitable. But now you also have a responsibility to make some tax payments during the year called estimated tax payments. And you need to calculate what those ought to be. So you're going to do the same sort of math. You're going to say, okay, I think this second year I'm going to make a certain amount of money. And say you think that money's going to double. Say you think you're going to go from $100,000 to $200,000. The good thing is you don't have to pay estimated taxes on the $200,000. Okay? There are some rules in place, and I'm not sure exactly what the percentage is, but there's something they call safe harbor. It says just take last year's income, and I believe it's 10%. Take last year's income, net income, multiply it by 110%, and that's the amount you want to be putting taxes away for. So if my net income last year was 100 grand, then say I think this year I'm going to make 300 grand. I only have to do estimated taxes on the 110. Now, I recommend if you got the cash, do it on the 300,000. Take a percent of the 300,000 and put that money away and pay it. But you don't have to. You only have to estimate on the 10% increase in your net income. Here's the thing. Come April 15th, you will have to pay the difference. Okay? So you still got that same problem at the end of the day. So you really do want to put as much away and pay as much towards them as really represents what you think you're going to make in the business. So that's how you anticipate it. Number one, don't ignore it, because it's going to be your biggest expense and you're not going to be able to shed it no matter what you do and where you go to hide. Well, I guess you could go to hide some places, but you'd be without a home, you'd be living in your car and probably offshore. Obviously not tax advice there. Yikes. And then once you've anticipated it, if you do have the money, put it away. If you don't have the money, go to the IRS website, get yourself a loan. And then in the next year, know you need to start making estimated tax payments every quarter. And the cool thing is you don't even have to think about it, because when you file your tax return for this year, part of what that's going to spit out to you, whether you use TurboTax or whether you have an accountant that does it, it's going to spit out to you 4 receipts or cover pages and say, here's the one you need to remit on this date. Here's how much your minimum should be. Here's how much you want to remit on this date. Here's how much your minimum should be. So it makes that recommendation for you, and you can just file those somewhere that you know to pull them out every quarter. I think it's like April 15th, June 15th, September 15th, and January 15th. You need to make those estimated payments. So I hope that helps. Try to keep it as simple as possible. Taxes definitely aren't simple. So do go check out that prior episode on how to do the loan, because that helps so many people right out of the gate. But do remember, never forget, of all the things I've ever said to you about business, your biggest expense that you don't pay attention to is going to be your taxes when you're successful. And I'm pulling for nothing but your success. Okay, do we hit another one, Francis, or is that about right? All right, that's a wrap. That's all we're going to cover today. This is an all tax keep it simple episode. It's great talking to you. Please leave your questions in the comments below. We're pulling those questions in order to address them in future podcasts. If you know entrepreneurs who just have some of the most basic finance questions, this is a place you can ask them. No judgment. There's no question too stupid. I honestly mean that. And we will keep the answer simple. And I'll see you back here on the next episode.